All right. So today we're going to talk more about investing, places to invest money. Um, we're going to talk more about mutual funds. Some of the stuff in terms of down in the weeds, in terms of shorting and some of these different strategies, those might be a little too much. A little bit of information can do some damage if you try and employ it, especially with your hard-earned savings. But through mutual funds and other things, you have methods of being able to gain that same exposure without without actually having to do it yourself. You can decide on the strategy type stuff yourself if you're in that position or you've made that observation, and then you can find somebody who's employing those techniques, perhaps. And again, this is probably further out the risk curve than most people. And that's the other good thing about mutual funds is for people who just want to sit back and invest and not take those sort of risks. That's perfectly, you can, again, find that through mutual funds. What you don't want to do, and again, this isn't, I guess this is opinion, but it's mainly fact. What you don't want to do is hold money in cash. If you hold just dollar bills, you're going to get clobbered. Inflation will eat you alive, and you won't get to the goals you want to go to. So, I'm not telling you exactly what to do, but I'm telling you, at least in terms of just holding cash, that's kind of what not to do, certainly. Investing in mutual funds. So great product, super, been around for many years, but they it's I wouldn't say it's training wheels, but you're not going at it alone. You've got a mutual fund, perhaps a team, more established account, can be purchased through your 401k. Just takes the edge off a lot of investment things that you might be apprehensive about. Why are we not holding dollars? Because if you're holding dollars, you're flatlining. You're down here on the bottom in inflation. You're still trying to apply your money from, back in 1929 to today. Again, people talk about the Great Depression. Yeah, it was rough. But obviously I wasn't there. But you can see this line going down. But then you can see it coming across. Now, if you're some person who's approaching retirement age, you got 10 years left in your life, well, you got a problem, by 42, and then you're coming into a ward. And anyway, what you don't want to do is invest money that you're going to need in very short order. That's mainly the strategy. Yeah, but you can see this overall graph. So these are years, so this is the whole last century and part way into this century, and you want to participate in that upward growth. There's kind of some cool stuff to watch that's a little more, especially with depends on the weekend, whatever time you watch this. Couple movies I've referenced, The Big Short, really well done. It's semi-cynical, but justifiably so. A lot of people did a lot of stupid things, but it does introduce you to some of the people who kind of saw the situation and took advantage of it. Dumb Money, kind of cool. This was back with the meme stocks. Again, these things are. Big Short actually has a fair amount of education. And Dumb Money's it's kind of entertaining, and then we get down to Wolf of Wall Street. That's just semi-decadent. The guy just. Whatever it exposes the whole pump and dump, and in this scenario in Wolf of Wall Street, they're doing penny stocks, which are super low valued stocks, but these people for the most part have kind of migrated into crypto, so those people still exist, and that's why you got to have your guards up if you're going to be investing in that down in the get rich quick kind of schemes. But on The Big Short, it's kind of funny that Eisman, who was he's portrayed in the movie, and he exists in real life. This is a true story. and the guy clobbered him, but he made $1 billion, $1 billion. But my point would be that now, 15 years later, he's got $1.5 billion. So you may think, well, yeah, he increased that money, but that rate of return since then is not super impressive to go up. I mean, the inflation did that. So he saw a situation at one point and did really well. He actually had a hedge fund too, but anyway, now he's doing podcasts. So I'm not. I mean, the guy knows more than he's forgot more than I'll ever know. I'm guaranteed. But sometimes people assess one financial situation and maybe they're not a master trader. They just were really good in one situation. Which, hey, if you're gonna make $1 billion on a single trade, that's kind of all you need. The dumb money thing, the misconception on this, or the misleading bit on this, is it makes it look like these retail guys, the small guys, the you and I kind of people out of there, really turned it on the professionals. In the end, in further analysis of this thing, it was a lot of Wall Street people saw what these retail people were doing and positioned themselves, and Wall Street, took the money from a lot of other Wall Street people. So it all sort of works. And they get into shorting and short squeezes and stuff like that are kind of interesting. And then Wolf of Wall Street, again, probably not kid friendly. Depends on your kids what you're raising, but very, yeah, but it's fun to watch. But just keep in mind that everything this guy does, his incredibly decadent lifestyle, was funded by people who got ripped off. Now, again, these people who got ripped off, is it their own fault? Because, yeah, they were all trying to get rich. Nobody was in there. It wasn't like he was, out soliciting nuns or something. These were people who were trying to get rich, and yeah, he definitely ripped them off. Crypto, pretty exciting stuff. This is a crypto chart, and so it makes these cycles, has since kind of back in the inception. 2010, I guess, was the first part. Anyway, but this was kind of a no-brainer here for a couple, 3 cycles, where you just, I'll just sell when it gets to this part of the cycle. And it was based upon the halving. Now they think it may be based more upon just the overall business cycle. But the whole situation is changing because industry. Now, we'll talk more about this in mutual funds, but the industry has gotten involved. ETFs, exchange-traded funds that hold crypto, are the biggest. They're bigger than, it's the most successful ETF ever launched, exchange-traded fund. So there's so many people involved in it. It's not the dumb money, the knucklehead retail investors that are, it's an industry does not like these massive swings. They like the upside, but they don't like, these guys have people to answer to. They've got annual reports to file, and these big swings don't fit in what they're looking at. The other thing is the speculating versus investing. I'm not necessarily advocating speculating, at least not with your main chunk of money. I get it. A lot of people are in different situations, and you've got sort of your YOLO situation where you're trying to buy a home and saving money in a methodical savings account at 5%. It's not going to get you to where you're going to be, where you want to be. So people may be more inclined to take risks, but from what I see, especially reading the term papers each semester, students are way more cautious. I'm the one who should be super cautious, and I don't think I meet too many people who are as far out the risk curve as I am. But I can live with my choices because, at the end of the day, whatever. I'm perfectly content. I've traveled quite a bit, and there's a lot of cultures out there where, put me in some village with a PBR or whatever their equivalent is, and I'm just fine. So I'm I'm not that addicted to material things, and I can go either way. And anyway, money you can afford to lose. So yeah, especially if you're getting involved in crypto, just because of the nature of it, and any kind of speculating versus investing. Speculating is kind of get rich quick, and other things that are pretty far out the risk curve, and investing is more methodical and more something a college course should recommend. Disruptive change. You cannot deny the fact that crypto is going to be disrupted. There are so many things. There are so many things in the finance industry that are just absolutely going to be shook up and are being just totally disrupted by crypto. The fact that some guy in wherever, Ethiopia, Sudan, whatever their financial situation is, those people have not been able to participate in any sort of wealth. They've lived under, currencies that just deflate and are manipulated, and all of a sudden, if they have access to funds where they can transfer funds back and forth, even for folks that are in some sort of undocumented migrant, whatever term you want to use, to be able to send money back and forth and just say, F you to Western Union and all these other sort of predatory people who have made a percentage or a pretty high percentage off of all these transferred, and oh, that'll take a few days. These people can log on to a crypto account, transfer money internationally within seconds, and that money is instantly accessible. There's just a democratization of the financial system, and some of these fees and some of these processes that have been held by people for far too long, that's coming to an end. And it'll be interesting to see the financial world. Some of them are embracing it, and some of them are just going to end up under the bus. They're just going to get driven right over. So enough of that. Mutual funds. Okay, so mutual funds, well, they've got them. It's a mutual fund. I could set up my own mutual fund, and I mean, obviously, you take a lot of lawyers and regulation and stuff, but there's no limits on what can be held under a mutual fund, really. I mean, you can have stocks, bonds, you can have crypto, you can have real estate, you can have all kinds of stuff. Now, the traditional categories were stock mutual funds. So these stock is equity in a company, right? Bonds are essentially a loan product, a debt instrument. But professionally managed portfolio managers who decide what securities to purchase. So it's somebody else kind of involved in the process. Like I say, when I want to buy a stock, I do not just go, oh, this seems like a good idea, and go out on a sole source, pretending that I've got some unique expertise. Sometimes it helps to get maybe a second opinion on this. And maybe you know the broad strategy, but you don't know exactly how to employ it. Or you want a certain selection of stocks, a certain industry, but how do you individually pick those stocks? Well, all of that can be done through mutual funds. So it's a collection, let's say a very simple stock mutual fund. There's a situation right now. It's called the Magnificent Seven. The Magnificent Seven are the seven basically most profitable companies that account for huge amount of the growth in the industry. And it's companies. There's 7 companies: Google, Meta, Microsoft, Nvidia, whatever. 7 of those guys. And let's say you're going, wow, these Magnificent Seven, they're doing very well. They're involved in AI. They're doing all kinds of stuff. I want to invest in them. You could go and buy a share of each one of those companies, or you could just find a mutual fund that has purchased segments of each one of those companies. So they have purchased X number of shares of each one of those companies. They hold them together in a fund, and you can invest in that fund directly without actually going out and investing in that company together. Now, I mean, I haven't. Let me see if I can get out of this real quick. I mean, what I'm telling you is, I'll just call it Mag 7 mutual fund, and I guarantee you there's a bunch of these out there. ETFs. Okay, so don't get wrapped up. The difference between an ETF and exchange traded fund, not drastic. But these are the companies. So what I said, Alphabet, which is Google, Amazon, Apple, Meta, Microsoft, Nvidia. Anyway, you could, exposure is what I'm talking about. That's basically owning a chunk of all those. And then there's going to be a whole bunch of these companies out there. Round Hill Investment. Okay, so if I find, let's say I've never heard of these guys, I'd be a little apprehensive to tell you the truth. But this Round Hill seems to have a tailored product to it. You can go on Reddit and get some random person's opinion, which oftentimes is maybe better. But anyway, you'd want to know a lot more about Round Hill. You'd want to know about their expense ratio. You'd want to know what kind of fee they're charging for this thing. We're actually on their site now. And, a ticker symbol. So anyway, I mean, that's how it works. You say, I want to, invest in, let's say Vietnam or just the Pacific Rim, something like that. For some reason you've traveled there and you go, let's base it more scientific, but you've got some inclination that, here's ones for individual countries. Let's go with Malaysia, for example. You can find a mutual fund that's going to be involved. So, again, the sky is the limit. I'm not recommending any of these funds. This is just and we'll talk more about how to get that done. In fact, let me jump right in here. Okay, so this is Fidelity, huge company. Let's say I want to look at some mutual funds, so I just went under news. They're acting like ETFs and mutual funds. They are different. Exchange traded fund versus mutual fund. To you as the investor, not a huge difference. Okay. Look at this. All these different type of funds. I was talking about going international before, so let's look at that. They've got 1,282 funds in just that one sector. Fidelity, they're obviously going to want to sell you their direct company, but these guys, they don't want you straying away from their site. They'll sell you other people's stuff just as easily. So Morningstar, when I'm saying going out with an opinion rather than just going out on your own, I want Morningstar, which is a third-party agency that rates mutual funds. I want their opinion. So I want something that's highly rated under Morningstar. So let's look at that. Boom. All these international funds. Now you could pick the region if you want. There's just so much to be done. If you prefer, they have a different type of approach here. Let's see. Don't know where to begin. Any provider, right? And I want potentially higher. Why would you say I want something that has crummy returns? But some people are super focused on low expenses. Expenses, I don't mind paying a higher expense fee if they're outperforming. There was a guy, Peter Lynch, had the Magellan Fund back in the day. Their expense fees are high, but their returns were higher. So if I'm paying 3% or 5% versus 2%, but the guy's getting me 35%, I'll go ahead and this guy's like this sort of rock star coach. At least he was back in the day. He deserves the money he's getting. So I don't get too wrapped up about that. But yeah, I want the I'm going to take the riskier one. And then I'm going to go down here for, has a manager. This guy just wants to hit even. Now, if it's an index fund, and we'll talk more about this in the homework, sometimes the index funds do quite well, as opposed to this person who's sort of meddling. You'd think, oh man, I want the guy who's going to be buying and selling and doing very aggressive tactics. Well, number one, he's getting paid. And number two, he's creating a lot of churn, and he's trying to do market timing, which is hard to do. Sometimes just to buy and hold under an index is different. An index just means, let's say you have the Standard & Poor's. That's an index. If you buy one share of all the Standard & Poor's and just hold that, well, you know, a monkey could basically do that. And sometimes that's good because monkeys work for cheap. You know, a few bananas here and there, and you're good. So the expenses are nothing. And if the overall market, if that index is going up, then anyway, so that will be, you'll see that in the homework assignment that we'll talk about. Okay, I'm going to go with the actively aggressive guy. And I'm going to look at the 53 funds that meet this criteria. These guys are smoking 35% in a year. Over 10 years, 20%. So let's say we got that $1 billion that Steve Eisman had back in 2015 or 2007, 2008. He made that money. Yeah, that money would be worth a lot. Thing called the Rule of 72. This isn't testable. It's not exact science, but it's pretty damn close. But it's good to know. If somebody says, hey, and this is whatever, there's some application to it, but the Rule of 72 basically means you get whatever interest rate you're being paid, whatever interest rate you're earning, you divide that into 72, and it takes that long for that money to double. So let's go with the Eisman thing. Now, not that this guy, well, they've got 35% over 3 years. Okay, so if you divide 35 into 72, the numbers work out sweet. It goes in there twice. That means if you got $1 billion now and you're getting 35% interest, in 2 years you have $2 billion. You know, even if you're getting, let's say, more modest returns, all these guys are smoking. I mean, we're up in the 20s. I mean, granted, this is a bull market. It could change. Things could happen. You know, are we in a bubble? Probably so. But bubbles, just before they burst, man, they go up. So you don't want to be sitting on the sidelines, but you got to get off the field at a certain point. Anyway, let's say you're down in just a 10%, you know, 11% in this case. You divide that into 72. In 7 years, you're doubling your money. So, you know, the value of compound interest is huge. And then the other thing here is, this is actually my account. I'm signed in. So all the Morningstar stuff is provided. So a Morningstar rating, 5 stars, which means, yeah, Morningstar approves. And then because I'm in my fund, I mean, if I want to buy, I just hit the buy button. It's that easy. It's not hard to do at all. Okay, so rein it back in. We're off on a tangent. We're getting back to mutual funds, but I think you kind of understand. Well, one last thing I want to look at, since we're there. Anytime you're looking at a mutual fund, you want to figure out what's part of this fund. So there's a thing called a prospectus, and that tells you kind of the rules of the road, what that person's manager, committee, whoever it is, what their rules are that they need to, you know, go by. Here's some more information. So the Morningstar category, when the fund was built, so since 87, it's been around a long time. Expense ratios, 0.61%. Net asset value, think about is that's like a share price. What they do is they get all those different shares under that mutual fund. They add them together and they divide it out, and that essentially equates to a share price. You can get involved for $20 if you want, 0-0. So they don't care. 20 turnover rate means they're churning this thing pretty heavily. 1/3 about of their portfolios being flipped every year. This is how big they are. Sometimes these numbers can get so big that they're kind of the elephant in the room. They want to go invest in some small company, and they start charging around in that investment space, and all of a sudden people are like, oh boy. And so they'll distort the stock price just because of supply and demand, just because of the size of that thing. And a range, 12-month high and low. I mean, here's the manager. I don't know the guy, but maybe he's had some good success. Here's the top 10 holdings. So this was what I wanted to see. Look at this guy. He's holding the Mag 7. Do you notice that? Okay, Avgo, which is Broadcom, Netflix. So if you go, wow, I think the Magnificent Seven's done quite well, and I think I want to be in that. So is this guy a super genius? No, he's buying the Mag 7. I mean, sometimes the genius is, just to buy the Mag 7 and call it good. And you're going to find what's going on. Top country, so mostly invest in the U.S. They're into high tech. Just a whole bunch of stuff here. Disclosure, strategy. So just a ton of information. But, you go into this as a fairly well advised. You've performance and risk. I mean, this is just the summary. You could dump into this thing as much as you want. The ratings. So we kind of saw Lipper, another company who rates these. I mean, this thing's maxing out on the Morningstar. They definitely like this fund. But again, look at those underlying assets. He's buying and holding the Mag 7. Good on him. You don't necessarily want to be a contrarian. You don't want to go against the flow when other things are working. Very much in the tech. No real estate really to speak of. Fees. Are they earning? I mean, if they're getting the returns they are, most people will give them a pass. If you're getting clobbered, if the market is not competitive, and then commentary if you want to, read somebody's interpretation of it. Anyway, so a lot of information out there, super easy, friendly. You go to those individual stock companies and, the companies that sell that stock, and it's just a harder process. This is quite easy. Okay, so now we're back. So motives for mutual funds, small initial investment. I mean, obviously you saw that you get involved with whatever amount you want. Expertise of the portfolio manager, specific investment goals. Net asset value, I showed you that, right? That's basically the stock price. But since they don't just hold one stock, it's just a combination of all that. Load versus no load. Do not pay a load. No need to. This one, if say, your buddy comes up to you that you, former classmate, and I'm working for whatever company, and I think you need to get involved in this, and they're on a commission. Well, that commission is going to transfer as a load. The problem with that is that load is a front-end load. So you invest, say, $1,000 to start out with, and if the commission's 10%, well, you really invested $900. And the problem is the compound value and all that other stuff. The fact that they took their commission on the front end means it really hurts you in the long run when that money, because of the time value of money, it was not acted upon. I mean, it's literally costing you thousands in the end, because that money that you're putting in initially, that's the money that would have had the longest time to be worked on. I've got a brother-in-law that he's a salesman. He does insurance, but same sort of concept, where he has a thing called his book, and it's counts that he started from long time ago. He doesn't even do that. He runs a winery now, but he still gets money every time those people renew their policy. And those commissions continue to accrue. Needless. So, plenty of good no-load funds out there. You generally don't need to pay a commission. Here's a person. This is a no-load versus load. This is what they're getting to in terms of the fact that in this no-load fund, you invest $5,000. You invested $5,000. That's the amount that's invested. Here, 200 of it went to commission. So this time, you go through, you look at the yield. All right, made 10%. That's cool. This person, just because they sucked out that 200 initially, their yield's about half. So if there was some value to it, but generally there's not. Expense ratios, yeah, am I concerned? What was the expense ratio that one? I think it was 1.6. So the guy's in the ballpark. If he's knocking it out of the park, if I'm making 30%, now again, this is semi-unrealistic because you're looking at the top of the top, and you're looking at a fairly good market, but it relates to their performance. Expense ratios and performance, so that's what I've been talking about. Types of mutual funds, we could make 40 slides out of this. If you're going to put them into a couple different categories, growth, it depends on those companies that are underneath, so that's what characterizes it. So growth means that it's growing. Capital appreciation means that are growing at a very high rate. So there's other types. There's more conservative. These would be maybe not smaller. I mean, there's nothing about NVIDIA that's small anymore, but there's definitely in a growth fund. But then you get into the size, the capitalization of the fund. There are dollar figures that translate, something billions equates to small cap, millions actually, but we're not necessarily gonna go there because those numbers are not that important. But you've got companies that are trying to make money by increasing their share price, and then you've got other ones that the share price you don't expect it to necessarily go up that much, but they're paying a dividend. Right? So small companies are going to be getting their profits, and let's hope they're making profits. If they're not making profits, we're not investing in them, right? Or not, have the potential for profits. But anyway, it gets more involved. But let's look at a company that's growing or has huge potential. You're expecting that share price to go up. The share price is going up, even if it's, say, a company that's in a great field, not necessarily making a profit yet, but stock prices are forward-looking. People expect it to make a profit. I mean, Amazon didn't make a profit for years and years. Now it makes nothing but profits. Well, the people who invested way back when it wasn't making a profit, but could see the potential, they were handsomely rewarded. Now, other companies that are more established, let's say like Ford or Coca-Cola or whatever, I don't really hold a bunch of those companies, but the reason why people would hold them is these companies are big, but they're not necessarily growing anymore. And when they do get profits, they return them to the shareholders in terms of dividends, right? You're not expecting the share price to go up much, but what you are expecting is you're expecting dividends to come in terms of income. And I've never been so interested in the income. Now you can reinvest that income and buy more shares, or you can actually live off it. A lot of older folks or more established folks, further along in their will want those dividends to be their source of income. For me, I've always been down in trying to get these companies that are growing, and I'll accept no dividends, but I want that share price to go way up. And then you can get combinations, balanced growth, sector funds. I had looked a little bit at a sector already. I mean, essentially you can see that growth fund that we had where all their stuff was in the Magnificent Seven. Well, they were essentially a technology fund. Or you can do it like I was talking before. I somehow chose, well, I guess Google chose Malaysia. But anyway, I'm not saying there's anything special about Malaysia right now. I would not just, randomly be investing in a country. But if I had some potential to think that they were going to go, that would be another sector thing. The other thing about mutual funds is just like I'm saying, if let's say you want to invest somehow in Malaysian companies, you can't go just buy Malaysian stock. The compliance, the problems, the currency exchange, for most of us, almost all of us, the lack of knowledge would no. Find a mutual fund, a company that's trading in dollars in a U.S. exchange, that's invested in that country and has all those lawyers and all those currency things figured out, and then get the exposure to the market that way. Index funds. So this is, like I said before, an S&P one like SPY or QQQ or some of these other ones that where they don't pretend that they're going to outguess the market. They're just going to buy a broad range of all the companies in that index, and they're going to buy and hold them. There's not going to be any trading done. The expense ratios are going to be about nil. And if the index is going up, you're making money. International stock funds, what that means, international in terms of stock definitions, means outside of the United States. Now, if you say, borders don't matter to me in terms of investing, I want the highest yield from anywhere, well, then what you want is a global. Global means anywhere to include the United States. International means outside of the United States. So I'm not sure I'd buy an international stock fund because I want the fund manager to have the ability to invest anywhere and to include the U.S. So I don't know why you go international rather than global, but that's just me. Socially responsible stock funds, we all have our own opinions on this, but there's a lot of greenwashing going on. There's a lot of people who claim to be socially responsible, but our returns suck, but we're socially responsible. No, I don't know why your returns suck, but maybe it's because you're not so good at this. Maybe there's some other issues. A company that's doing something responsibly tends to be profitable. Companies, there was a big company called Union Carbide, and they got clobbered. They had a battery plant in Bhopal, India, way back when, and they weren't running things quite right, and taking a lot of risks, and a lot of people died. And but they were outside of the United States, so they didn't think, their bad actions would catch up to them. Oh, they did. And that company barely exists. They were not socially responsible, and the market took care of them. That company did not make money. I mean, things sort of take care of themselves to a certain extent. I mean, there's exceptions. Some of the cigarette companies and some of those people have truly might have bad motives, but for the most part, running things unscrupulously tends to catch up with people. Running dirty operations tends to end up with big problems. If you're a company that's creating a lot of pollution, it's probably going to catch up with you, and you're probably, it's probably going to be reflected in the stock price when you got to clean up that mess. So I think most companies tend to be socially responsible because there's more money in it to be a better company. But when and again, I'm not picking on Subaru here, but when they talk about being love or something like that, or zero emissions, who are we fooling? I mean, it's an inanimate object, and zero emissions. Well, if you discount the power plant that's generating the power or whatever, a lot of these things just, if you want to have the best company possible that is going to be socially responsible. But if I'm just very leery of a mutual fund company that starts out saying they're socially responsible and you scratch the surface, you find out it's more marketing and less actual actions. So, but you can find those ratings out there, and if they're genuine, that's a great thing. If it's greenwashed, well, then that's not so good. Other types of mutual funds. You have small cap growth. You can get way down in the weeds. There are so many mutual funds out there. Now, the exchange traded funds, they can be index funds, but the good thing about these guys is for regular Wall Street, regular brokerage, it's almost like the bank situation where when we talked about banks, I mentioned that whether they call themselves a savings and loan or a credit union, it's fairly transparent. If you're on the retail end, will they transfer my money around? Will these guys hold certain companies? Whatever. The difference between a mutual fund and an exchange traded fund it's down in the weeds. I do like the fact that funds that can be traded, but they can all be kind of traded through the brokerages. But what you don't want to get locked into is some mutual fund where you've got to use a fax or have some sort of delay to get your money in and out. When the market's moving fast and for some reason you want to get out, a mutual fund company that's responsive is helpful. But again, the companies I've dealt with, and again, I keep talking about Fidelity, but that's where I've got most of my money. It's transparent. Getting back to the GameStop thing and that whole dumb money, if you remember, there was AMC Theaters and GameStop and some places like Robinhood, limited trading. Fidelity never did. I had it was TD Ameritrade. They've gone away. Now they're owned by Schwab. But they limited my trading on those stocks, and that was unforgivable. I will never do business with a company that stopped my trading. So on that particular day, when I tried to execute that trade, I think I was trading AMC, and Fidelity put through my trade where my friends who were using Robinhood, their trades were suspended, and that left a mark. So anyway, lots of good companies out there, lots of good exchanges, but the difference between an ETF and a mutual fund, pretty minor. Vanguard, another big company. Maybe I'll show one of their slides here in a day or two, or another lecture, but huge company. The thing about these big companies in terms of choosing which one to go with and which one to kind of be associated with, if your employer's associated with one, that's kind of the direction you're probably going to go. Back in the day when I started with Fidelity, it was UAA had like 5 or 6 companies, and so that's why I was kind of guided towards that one company in particular. But at the time, I was primarily a TD Ameritrade Schwab trader. But when they limited my trading during the GameStop thing, I'm like, we're done here, and I moved on. Types of bond mutual funds. So you can put bonds under here as well. Obviously, the performance is going to be a little different. But depending on your risk appetite and what your inclinations are, you can, rather than try and buy individual bonds, you can just do it through a mutual fund. And so you can buy small amounts. You can set up an ACH debit. You can get back to the basics and the whole pay yourself first thing. You can say, I want 15% of my money each month. That's going to be allocated on whatever the first of each month, and it's going to be transferred into whatever mutual fund. And perhaps you're so inclined to get a bond. Not for me. High yield. So within a mutual fund, it can be a collection of high yield junk bonds if you want. Could be munis, could be index bonds funds. So the Big Short is pretty good at illustrating, though, what happens. The concept in the Big Short was people, this was back during real estate boom, and people thought, man, real estate can never go down. It can, and in certain markets, it certainly does. You get into some places like Phoenix, Miami, Las Vegas. Anyway, some places that are pretty speculative, and they can have huge fluctuations. And so at the time, though, back around 2007, people thought, man, you cannot go wrong buying real estate. So people were buying real estate, and they had what they call ninjas. No income, no job, no assets, but yet they're still getting a loan. And not only are they getting a loan, they're getting multiple loans. Well, when you look at the rating of that loan and the underlying assets, that's not a good loan. That's down in the subprime category, not a preferred thing. Well, what they were doing was getting all these loans and putting them together, putting them in a single product, and saying somehow we got all these crappy loans and we put them together, and they're better because they're diversified. We realize a lot of this is down in the junk category, but somehow when we combine them together, we've got this diversification that's going to upgrade them all. Well, it didn't happen that way. You gain a little bit by having a little bit of diversification, since it's kind of like insurance. Not everybody's going to have a bad day on the same day, but just the same, the underlying assets were weak, and because they were all kludged together, it was kind of opaque just what risk was being involved. And then everything fell apart, and these bonds went way down. You can do international bond, so you get the exposure to international bonds if that's what you want to do. Again, it depends on what criteria you've got, why you're looking that way. Investing from a mutual fund. So if you're involved in larger companies that are paying a dividend, yeah, you can just tick the little block, check that little drop-down menu, and rather than them write you a check for your dividends that month, no, you can just have them reinvested, which is usually the easier way to go. Capital gains distributions, if they're churning these stocks, if they're selling them underneath, they could pay you those dividends directly or those distributions directly, or you just have them reinvested. So I usually just take both those blocks. If price received at redemption, so when you sell a mutual fund, they're going to look at your basis. They're going to look at what you paid for it. So you paid $30 a share, and $30 net asset value, and it's now trading for $50. You made $20, and it's just like selling stock. Not a big deal. Now, if it's under a 401k, it's handled a bit differently because you don't necessarily have capital gains. Whenever you pull money out of a 401k, it is treated as earned income. So short-term capital gains, long-term capital gains, total income. Technology, so probably a little higher risk, or they're showing more short-term gains. Short-term gains are taxed at your regular income rate, so whereas it's short-term, so they're showing 28%, so about double in this case. These are just, it depends on your tax bracket. Dividends, long-term capital gains, typically taxed at around 15%. So anyway, because they held more long-term, their income is a little bit higher. Now, you can make a gain and just, again, watch the calendar and, it's been greater than a year, now I'm going to sell, and boom, now it's a long-term capital gain. So when you're buying and selling stock and you've held it for, say, something like 9 months, well, if you want to stretch it out and hold it 12, it's going to change this 28 figure down to 15. So that's definitely a strategy. Risk in investing from a mutual fund. Yep. It's the same sort of thing for the underlying stocks, but there is diversification. Again, we go back to the Magnificent Seven. One of those companies may have a bad year, but you're not solely invested in just that single company. You're invested across that whole range. Granted, it's still pretty focused, but you're not going to be overly adversely affected by that single company's failure. Yep. If you stay on the porch You know, you're not going to get much if you take a little more risk. But risk and return, they need to be related. You don't want a whole bunch of risk with very little chance of return. So, high risk, high return. What you don't want is something that through mismanagement is low return and high risk. These, you kind of know your chances when you're getting involved in it. Bond mutual fund, same sort of thing, like the underlying bonds. You have to look at what the underlying assets are. I don't know about this chart, this graph. If it's the NASDAQ, that's a fairly aggressive fund, group, a fairly aggressive index. If it's the Dow, maybe a little bit less. Global stock funds, I don't know. It all depends, The globe's a big place. Some of the big companies in Europe right now, Germany in particular, not doing well. Germany as a country is not economically not really kicking butt. I would agree with the technology being higher returns, higher risk. Foreign on one small country, yeah, that's definitely going to be because you've got currency risks and other things going on. But anyway, take this for what you will. It's you have to evaluate each stock individually. So anytime you're in a shorter term, you're making a forecast for, it's like looking at a weather forecast. Is it going to rain today? Well, you can get up in the morning and have a pretty good idea. Is it going to rain 2 weeks from now? There's a lot more variables. So, yeah, there's going to be more risk because you're making a forecast further out. And then this one is, T-bonds, so those treasury bonds, government securities, not much risk. Here we're out in high yield junk bond category, so yeah, that all makes sense. So same as the underlying bonds. Longer term bonds most sensitive, default risk certainly. Conservative, moderate. So in T-bills, the government needs to fail for that not to pay off. People need to lose their houses. A little bit more security. Most people aren't going to give up their house like that. Junk bonds, you already knew it was junk when you bought it. So, yeah, don't be shocked if things don't work out well. So, So go through those charts, figure out what you want. Now, again, if you're working for a company, they'll probably going to limit your choices dramatically. I used to be involved with what they called it self-directed, where I could get 50% of my total 401k, and I could invest them directly. In the other 50%, I had to keep in their fund. It was conditions with the company I was working for, and it was just ridiculous because they'd come back to me each year and they'd say you need to rebalance your account, because what would happen was the 50% that I was managing was kicking butt, and the 50% they held was no longer 50% because so let's say you start out with 100 grand at the first part of the year. I could put 50% self-directed and they could manage the 50%. So at the end of the year, they go, oh, okay, the portion we manage is now worth, $52,000. The portion you manage is worth $150,000. So you have to rebalance it. You have to buy more of our crappy fund. Now you got, $200,000 total, but you've got to take a bunch of your winnings and buy more of this crappy fund that we own to rebalance it. Anyway, it was kind of ridiculous, but I'm not saying you just got to read the room. You got to look at the market conditions. If you're in a bullish market where things are going up, you want maximum exposure. If things are going down, you're in a bearish market, you want to be more defensive. Investment objective, this prospectus, that's the document you're going to be looking for when you're buying mutual funds. And it's going to tell you sort of all those different things we looked at in terms of what their underlying holdings are, what their strategy is, the rest of it. Performance. So again, we can see all this now with charts and other things that are just much more useful. Fees, expenses. Yep. Risk. Fairly subjective. What you're going to do with your dividends and your capital gains. Minimum investment. How to redeem. And I mean, again, some of these things are just so easy. You just click on the button. Minimum investment, there isn't one. Boom. Consider the following tables. 4 stock. Now, I'm not going to limit myself to 4. I'm going to look at myself to thousands. We've already been to the Fidelity site, but again, I'm not shilling for Fidelity. You can look at a variety of these companies, and they all have pretty good products. Fidelity, Vanguard, T. Rowe Price, whoever. There's some that cater like to teachers and stuff. What is it? Crafted. Anyway, different big companies. Most of them are based out of Boston for some reason, back on the East Coast. TD Ameritrade used to be based in Omaha, but I don't know where they're at. Schwab is the overlying company with them now. Quotations for mutual funds. Yeah. We're going to get this data off of chart just like I showed you before. So these numbers, when you're looking at a newspaper, this is just so limiting. There's a bond fund. Yeah. Far easier to look at a chart rather than tab data. This Mutual Fund Education Association, again, most of the time, most of these companies, like I say, they want to keep your business. And so to find out information on the competitors is normally not that hard because, essentially it's like going to, let's say you decide you want to buy a truck and you go to the Ford website and they give you the ability to buy a Chevy through that website. You wouldn't think that that's normal. Well, you'll find a lot of the mutual companies kind of do exactly that. They want to keep you associated with their website. They want to be able to pitch and posture their products in front of you each time. And in exchange for that, they'll allow you to buy the competitors' products through their own website and through their own account, and feeling that they can build a brand loyalty to keep you on. So these guys are, an organization that's run by all the mutual fund companies comparatively, but I think most of the mutual fund companies now are smart enough to realize they aren't going to be overly aggressive in terms of stovepiping you into their own products. They're going to give you access to other people's products, so it kind of works. Diversification. So if you go, oh, I want some of this fund because it's the top performing. I want some of this fund. And you buy 3 or 4 funds, you think, oh, I've got diversification. Look at the top 10 holdings. If they're one of the top performing companies right now, they pretty much are holding the Mag 7. And do you have diversification? No, not really. You've got 3 or 4 different funds, all with the same underlying companies. So if you want diversification, and I'm not saying diversification just for diversification's sake, but if you're maybe looking at the market right now going, ooh, this looks a bit like a bubble, things are going up, maybe I've got all this stuff in high tech, maybe I want to branch out into real estate. I'm not saying that's a good move right now. I do not like commercial real estate with Zoom and everybody telecommuting and all the rest of that. But anyway, let's say whatever your thesis is, you can get diversification. You can find a fund that will put you in wildly different sectors. You you could be very pessimistic. Well, I don't know if it's pessimistic or what, but defense companies in Europe, they are kind of rearming a bit. If you had bought into Rheinmetall, the big German defense contractor, you would have been handsomely rewarded. And it's certainly not technology. But anyway, there's ways to diversify. Impact, diversification, limited effect, most mutual funds. Yeah, a lot of times when one company goes down, they all go down. Now you diversify. Maybe you're kind of a gold person. You think gold's going to do well and going to do better. I mean, to say gold hasn't done well, I'm not one to hold gold, but that would certainly be diversification strategies to hold some money in gold outside of the stock market, or perhaps silver or crypto. There's lots of ways to diversify. Yep, we saw that. Europeans, I would be very. A lot of the policies in the U.S. right now are pretty pro Canada. Oof. Canada, their stock exchange too is the Wild West. It is crazy up there because they do a lot of mining stocks, and it's nuts. I've never invested much, but it goes from being a quiet little country up to the north to the Wild West in terms of stock market. Hedge funds, broad name, it has this sort of sinister thing. A lot of times, at least they started out as being diversified. They would take opposite positions on trades where, regardless of whether the market went up or went down, their wealth was preserved. And that was the hedge, the hedging feature. They take contracts, literally making money if the market went up or went down. And so if there was volatility, they still didn't necessarily make a bunch of money, but then they preserved their capital. Now this whole broad category has been termed into things that don't have so much to do with hedging, but just have just very aggressive financial strategy. So anyway, it's a misleading term a lot of times. Bernie Madoff, yeah, it was a Ponzi scheme. People were getting 20% for absolutely no risk. Well, as we know, risk is related to return. And these people didn't do the research, didn't care. They trusted their buddy Bernie, and he ripped them off. What he did was, it's a Ponzi scheme, a pyramid scheme. There was actually a guy named Ponzi who did this initially. But you take in money and you pay it back to the new people. So, or pay it back to the established people. So, somebody invests $10,000 and you get that money and you give it to the other investors and say, look, our fund made $10,000. No, you just got that money from these people and you gave it to somebody else, and no wealth was created. And oh, by the way, when the new people, when they finally get in line to say, where's my money? That's when Bernie or Ponzi or whoever needs to run off and go to some other country, because that money doesn't exist. They gave it all away. Okay, homework. So, this is something you'll hear people talk about. Oh, it's a tax-exempt fund. It's a muni. That's what I want because I don't want to pay taxes. Well, that's all well and good, but you need to know what your tax bracket is and what your tax exposure is. And so when somebody says, oh, I'll give you 10.2% on a, fully taxable investment, just a normal investment, or you can get nearly 8% and it's tax-free. What do you want? Well, you need to do a little math to figure that out. And simplicity-wise, you go, well, if I make 10.2% and I'm in a 28% tax bracket, it means I only get to keep 10.2% minus this 28%. So if I multiply 0.28 times 10.2. So we're talking basically a third here. It's going to put me down in the 7% range. And I need to be more precise. Is it higher than 7.9 or lower than 7.9? Anyway, that number is going to determine the answer there. It's not that difficult. Now, if you're in a tax rate, let's say you live in California and you're, doing well, and your tax rate's 63%, well, this whole equation is totally changed. But if you're in Alaska and you're not making much money and you're not paying much in the way of federal taxes, well, then you want the 10.2. So it depends on this tax rate where you're going to be. But anyway, the numbers are set for this one. These other ones are fairly straightforward. We talked about supply and demand in terms of the attractiveness of your bond. And that's about it. So it's all pretty good. There's another podcast type thing that I'm going to put out. It's getting a bit dated now, but it still explains some of the fundamentals, some of the reasons why this actively managed type fund versus a index fund. They both have their merits, but it all has to relate to market timing. The fact that you think you can jump in and out of the market at the right time and get it right. Human intuition and just vanity and our own pride makes us think that we can jump in and out at the right time. But experience and just the numbers generally show that that's not the case. And so it goes into this whole discussion. There's a guy named Warren Buffett, and then there was the guy with, I think he was Vanguard. And the Vanguard guy was a big proponent of, you need to, I can do better. I can get in there and buy and sell and time the market and do all this well. And, oh, by the way, I'm going to, generate some fees because of all this churn I'm doing, and I've got to be paid and all the rest of that. And then you get the Warren Buffett approach, and Buffett's approach, at least in this category, was I'm just going to buy and hold and have very low expenses and make money that way. And so anyway, it's just an NPR, it's just an audio thing, but it's getting old. It's almost 9 years old. But they had $1 million bet because these guys are both wealthy as whatever. $1 million going to some charity, and they came up with that. I might look for a new example of this, but it's still pretty good because the situation hasn't changed that much between index funds and actively managed funds. Term project. So again, just that little bit I showed you on the Fidelity site or whatever site you choose, you can start putting this stuff together. You can go through it. I don't want just a checklist. It needs to be, a proper paper. But these are kind of the areas you need to address in the paper. And that's it. Oof.